Hey guys, and welcome back to Inside Investing. And today we're going to be discussing how you should be responding to a market crash. Let's go. So guys, market crashes, they might come sooner rather than later, you never know. And today we're going to be discussing how you should and how you could be responding to a potential market crash. Because yes, we've been reading in the news quite a lot, honestly, that there might be like a huge market bubble because of an increase in investors overall and a lot of money currently being invested in the overall stock market, more than actually some people say is healthy for the economy and for the financial markets. So that's why people are saying, well, there might be a potential bubble and a big crash coming soon. Of course, as you know, it's impossible to predict the market, right? So as you know, we are very big fans of just investing in a consistent basis, dollar cost averaging in the stock market. So buying each and every month for a set amount of money, buying your stocks. So let's say every month you're investing 50 or 100 euros per month, very consistency. You don't really care too much about the price. That's really what we care about. And that's honestly our preference and what we've been doing professionally now in inside investing, I would say, but also personally for quite some time. And that has really been giving us very stable and steady profits. And if we now look into DEGIRO, this is our DEGIRO account in our open portfolio. And we go to Vanguard FTSE All World Usage ETF, so this is VWRL. We can see that actually in the last 2 to 3 years, there actually has been quite a big dip. And this has been because of the global pandemic. So what we see right there is that the market crashed from around 88 euros to approximately 59 euros. And that all decreased in like a 1 month period. So that's a very short period in which you see that the market dipped so significant. However, if we then look in the future a little bit, then we do see that at the end of 2020, it nearly got back to the same point it was at the peak before the market crash. And that's why we are honestly very big fans of just dollar cost averaging, meaning that on a monthly basis, you're just buying for a set amount of euros very consistently in the stock market. You don't really care too much about a dip or the highest point. You don't really care about that too much. You're just buying on a consistent basis, new stocks each and every month. So every month you're investing, let's say 100 euros. It might be high, it might be low. You don't really care too much. That is difficult though, because I must admit that your emotions will probably get the run of you and they really want you to that feels very scary, right? You see the market crash and you see it go down and down and down and you're like, oh no, what's happening to the market? Perhaps it's going down to zero. Am I losing all my money? And what we're saying is no, you're not gonna lose all your money. At least that's not what we've had until now. Of course, you need to do your own research. That's always very important. Also, you only should invest the money that you can afford to lose, and actually money that you also don't need, right? So if you would be like, I need this money in a year from now, then yes, it might be very shitty if you would have invested all of your money right there. And then you say, well, somewhere in the upcoming 2 months, I need all of my money. And then you see decrease, boom, boom, boom. And then you need to sell all of your stocks for, let's say 66 euros. Yeah, then you would have a huge loss, honestly, like from buying it for like 84 and then selling it for 67. That would be very shitty, guys, of course. So that's why we say you should not invest for the short term. You should really invest for the long term. Then you can see a very steady increase in market value, and then also your results are going to be very stable. So going back to 2013, you see how very steady the market has been increasing. This is the usage global ETF, right, from Vanguard. So this covers a lot of different companies. I think more than 3,000 companies, honestly, from the total complete global economy. But you see that overall our global economy is going up. So then at least if you invest in the long term, you don't really should care too much about the market dip. So yes, there might be coming a market crash in the future. That might happen. You never know. You can't really time the market. There's never a best point in time to buy more shares. That's not, honestly, that you can't do that. The only thing you can do is say, well, I want to invest, and then you better start today than start tomorrow, because you want to have time in the market. You want to have more time You want your money to be more time in the market instead of being on your bank account. So that's overall what we want to do. We don't time the market. We're not timing the market. I'm sorry, we're not timing the market, but we want our money to be as long as possible in the market. So therefore, we don't really care about a crash. There might be coming one, but you never know. So guys, that's it for today. If you like this one, it was very short, I know, but this is just to sort of keep you prepared and just know how we think about a potential market crash. If you like this video, then please give it a thumbs up, subscribe if you haven't done so already, and we'll see you guys in the next one. Let's go.